Welcome, everybody. Welcome to Zoom at 8. My name is Julie Ann Peterson, and we meet here every Tuesday night. So thanks again for those of you who commit every Tuesday night. There are 6 other nights that you can go and carouse and have fun at the bars, but not on Tuesday night. Now, you can certainly bring your drinks with you tonight, and I encourage you to do that. There might be some excitement in that alone at your home. I don't know, but I am so glad you're here. And again, my name is Julie Ann Peterson. I'm with Old Capital Lending, and we are a premier provider of debt in multifamily. We've been doing this for 36 years. We close $1 billion a year, and we are unstoppable this year. There is so much business going on right now, and a lot of it is going in bridge. And the great thing about bridge is it's one of the only ways to get the deals done right now because the prices are so high. So if you're thinking about how you can get into a deal, I'd love to be able to help you. Bring me your T12, your rent roll, your offering memorandum, otherwise known as an OM, and your syndicated deal analyzer or any of the modeling tools that you use. And I can give you a high level of what one of those bridge loans will cost you and what it'll look like. I mean, right now, CapEx sometimes is, up in the millions. So if you can roll that into the loan, it is a spectacular product if we can get you in it. Agency has been a little bit more challenging this year. So we just saw a decrease, by the way, on Freddie, about 10 to 15 bips. So if you're in the middle of a deal and you are on Freddie, you're going to be at the higher rate, unfortunately. So and Fannie, they kind of go up and down. So you kind of ride the wave, and when you lock it, hopefully it's on the down cycle. So CSSI, Mark Gross is a regular here. There are companies out there that do this, so it's not necessarily a dime a dozen, but Mark is always present, always helpful. He returns calls. He's so available that, I want to support him. He does a great job. And he's one of our partners. So we're going to be using him on the Houston deal. And a lot of our clients have used him because they've met him here. So once again, we want to make our partnerships with the people that are supporting each of us. So what a great way to meet Mark tonight and his partner David. David is in Baton Rouge, Louisiana. I don't know if you guys know anybody that lives in Baton Rouge, Louisiana. I think he's like the second person I've ever met that lived there. But let's go through their bio. So David is CSSI Executive Vice President. He's a cost segregation specialist and has traveled the country speaking at CPA society events. Boy, could you imagine how exciting that is with a bunch of CPAs? Oh my gosh. As an expert in the tangible property regulations, repair regulations, that is. What happened here? You're joining now. Okay. He routinely provides assistance to tax professionals who are looking to understand the opportunities and pitfalls of these regulations. David has a unique ability to take the complex and tell a meaningful story. His talent serves him well in explaining the application of the regular regulation or the repair regulations. And then heading off to Mark Gross, who is our partner here. He's from Wheaton, Illinois, which is where I used to live when I lived in Illinois. He also is with CSSI as a national account executive. He provides cost segregation services for property owners nationwide. His projects include multifamily apartments, single tenant, which is triple net, industrial, retail, hotels, offices, etc. His previous background is in upper management, overseeing supply chain and operations for large manufacturers and a retail chain. So I want to welcome you to this dynamic group of Zoom at 8ers. We have closed 7 deals. We're waiting on a couple to be closing number 8, and I am hoping that number 8 is going to do business with you guys, because you know what? This is the reason why people get into, one of the many reasons to get into this a multifamily arena, because there's tax benefits. So I want to hear from you guys why we should use cost segregation and CSSI. I'm turning it over to you guys. Thanks so much for joining us.
Okay. Thank you very much, Julianne. David and I really appreciate that introduction. As you mentioned, I've had the pleasure to meet him actually in person and virtually with many of you. Julianne, when you were in Oak Brook this summer, and Jim Biggs. In fact, I was just at the Windy City REI this past Sunday. And so it's great to meet all of you, like I said, in person and virtually. One of the reasons why I wanted to have David Deshotels join us today is that not only does he do a superb job in doing presentations, because he's well-versed in doing that, as you mentioned, across the country, but also to give you an idea about CSSI. And it's not just about me. I'm going to be the point person that you contact regarding any studies for any properties nationwide. But we have a deep bench of management people and experts, tax specialists and engineers and things of that nature. And whenever there's something that maybe perhaps I don't know, I love the opportunity to be able to lean on this bench of people who have all this expertise, which is wonderful. So that's one of the reasons why I want to have David here. You know, we've worked together as a collaborative team for a number of years now. And some of you like Julianne and Jim Biggs, who are familiar with the Chicagoland area, will recognize the fact that I've met with clients with David here in Naperville, in Schaumburg, in Oak Brook, down the Loop on LaSalle Street, Michigan Avenue, River North. A couple years ago, we were at a convention in Navy Pier. So we work together very closely on a lot of things. So what I'd like to do at this point in time is kind of turn it over to David, let him get started. And go ahead, David.
Well, thanks. It's a pleasure to be here with you from Baton Rouge, Louisiana. Louisiana being one of the most progressive third world nations on the face of the earth. So Julie was giving me a little guff on that. We're the other LA, Julie. It's I know you California people think LA's everything, but you know, anyway, it's a pleasure to be here. This doesn't need to be a commercial. I would greatly appreciate you guys participating in this. So that's a strategic discussion. One of my favorite lines is, friends don't let friends overpay their taxes. So what we want to do is share some ideas with you and hopefully earn a seat at the table to be your depreciation specialist. Julie, you know, went through the list of value-added consultants that are on this team. If you're going to own real estate in today's age, you need a depreciation specialist, because there's so many deductions that are available to the commercial real estate owners that were not here before. During the CARES Act, during the pandemic, some of the legislation that was passed gave commercial building owners $175 billion of tax breaks. They only gave the hospitals $75 billion of cash. So, you know, there's a whole lot of deductions that are available to you. We're going to run through this, and I know no one woke up this morning and says, oh my gosh, I get to hear a mechanical engineer talk about the tax code. Oh, you know, I'm not going to run through all these, but I wanted to show you that Mark and I are going to help weave a conversation of all these deductions that are available to you to make you aware of those. So Mark, you know, are we going to make them tax experts in the next 30 minutes here? I don't think so. But we just want to bring it to your attention so you might be able to have a conversation with your tax professional as to, hey, should we be looking into this? Is this something that we're missing right now? Or when we buy this property, we want to make sure that we accommodate these deductions, these depreciation deductions that are in our favor. So what Mark and I are going to share with you are not loopholes. This is not something risky. This is just the tax code that's been changed in your favor if you know how to have the proper information on your building so that you can maximize the deductions that you're available. Mark, anything else that you want to do to set this up as to what we'll be covering?
No, I think you kind of covered it really well. We'll just kind of get into the nitty gritty, I think, at this point. So go ahead.
Yeah. And I stole all Mark's slides because he was supposed to go over those things. So one of the things is I'm big on better ideas. So what we're going to share with you today is better ideas. The great thing about ideas is that they're cumulative. So Julianne, if I give you $1 and you give me $1, we each have $1, right? But Julianne, if I give you an idea and you give me an idea, we each have two ideas. Ideas are cumulative. The bad part about ideas is what you already know prohibits you from learning new things. Let me say that again. What you already know prohibits you from learning new things. So Julie, I want to go through this exercise. Julie, I'm going to show you on the next slide in the audience. I'm going to show you the next slide for about 5 seconds. 7 little words that any third grader in the Louisiana public school system. So Julie, you know they're easy words. You know it. I'm going to show those to you, and then I'm going to ask you what they said. Okay?
All right.
Okay, Julie. So tell me what you saw.
That you love Paris in the springtime.
So, okay. So I love Paris in the springtime. So I said 7 little words that any third grader can understand. Either you can't read on the third grade level or your brain, which you already know, prohibits you from learning new things. So what happened to you is I showed you something that your subconscious brain read all 7 words and said, I've been taught since the 3rd grade, that makes no sense. It edited in your subconscious, sent it to your conscious, and you saw, I love Paris in the springtime. So let me show you that again. And Julianne, nobody else got it.
A little
either.
bit of pressure, man. I love Paris in the springtime.
I love Paris in the
Oh, look at that. Dang. Yes. In I stuttered.
That makes no sense. And so your brain edited it. I've shown it to thousands of people. Only about 42 have gotten it out of the probably about 5,000 people that's seen this. It's just the way our brain works. So what we're going to be sharing with you today is better ideas that may be a little bit different than what you know. So, let's get past what you know and look at these new things. So cost segregation, we're going to talk about. Mark, I'll do this slide if you're okay. So what is cost segregation? I use the Big Mac analogy. And Julie, stay with me.
Okay.
You might be old enough to get this. I use the Big Mac analogy on, if I'm to describe a Big Mac, I can use straight line depreciation methodology to describe it and call it a hamburger, right? It's just all one piece. I'll call that a hamburger. But if I were to use a cost segregation methodology to describe that Big Mac, what would I call it? Julie's too young. So Jay knows this. So this was a commercial about 40 years ago where every kid in America knew the jingle. 2 all beef patties, special sauce, lettuce, cheese, pickles, onions on a sesame seed bun.
I got that.
Yeah, there you go. So it's so usually what happens, Julie, when I do this in a room, all the millennials turn their head at the person that just did what you did, and they go, "Where did that come from? What the hell?" So as kids, we all knew that. But cost segregation method is looking at a building in its parts and pieces, and the cost segregation specialist looks at the building all throughout it and identifies all the parts and pieces that you're able to depreciate in the first year. So Mark, I'll let you roll on with a description of cost segregation. I'll let you go through some of these slides, if you would, please.
Sure. One thing we need to identify is the fact that what CPA will typically do is a straight line depreciation for multifamily or residential properties. That's going to be your 27.5 years. For all of your other property types, that's your 39 years. That's the 3rd bullet point there. And the other thing to keep in mind is that when and we'll show you a graph later which will depict this, when you look at what your depreciation costs are, what you're basically doing is front end loading a lot of your depreciation costs. So if you were to hold the property for the entire period, you're still going to be paying the same amount, however you're going to be paying it with less expensive dollars, and also looking at what the time value of money is. And that, again, is the second part of the 3rd point there. So how much can you save on a cost segregation study? Well, the range might be from $30,000, $80,000 per $1 million in what you paid for the property. And one thing you need to exclude, of course, is whatever the land value is, because land cannot be depreciated. And what we typically say is that we'll do it for buildings which are $350,000 or greater in cost, and also take a look at what the TI tenant improvements might be as well. Return on investment, typically 10, 30 times. Sometimes it's going to be lower on lower properties, or I'm working on one in Connecticut right now where it's actually going to be a little bit less than that. But the problem with that is that the CPA didn't recommend that the owner do a cost segregation study on it. He's actually owned it for 5 years already, and now he wants to have one done. Well, we can still make it very advantageous for him. However, it's advantageous to do it the first year that you acquire it to retain the most benefits possible. Anything else you want to add on that, David?
No, you're good.
I do have a question on that before
Yeah,
you
go
go. How soon after you close do you need to do a cost segregation? Is it within the first year? Let's say if we're buying it in November and I want it for 2021, when do I have to have that cost segregation done?
You want to do it before your taxes are completed. Now, the thing that some people are under misconception that if you're buying it in 2021 that you have to have the study done that year. That's not correct. You just have to have that completed prior to when your taxes are filed. Now, we have a lot of our clients that actually extend their taxes. They don't do it in the springtime, they do it in the fall. And what that does is extends that period of time. So you could actually buy something toward the end of 2021 and not actually have the study done until later in spring or summer in time for fall. Now, I will point out that we get incredibly busy prior to tax seasons and they get backed up. So I wouldn't suggest that anybody procrastinate and not do it early, but it doesn't have to be done in that calendar year.
But keep in mind, your investors want to get that done. They want to be able to file their taxes. So you're holding them up. That's not looked at as favorable. So if you can get this done before April 15th, I would highly recommend it.
Yeah,
you're in good standings with your investors.
I agree. Most of the other ones that are extended, at least from my experience, from my clients, they're ones they're single investors, mm-hmm. and it's not as big a deal for them. But your point's well taken.
Yeah, and Julie, I'll echo that. So if you have a building that you haven't done cost seg and you want this done for next year's tax returns, start late October, November, December to get this done. So in January, you've got the results, and therefore you can apply those for your March 15th deadlines or April 15th deadlines. So really, we're coming up on a period of time. Now's the time to start taking action if you want it for early 2022, I guess.
Yeah, because you don't want to give it to your CPA or tax professional at the 11th hour, because they need time to be able to get that information applied toward the taxes, and they're busy enough with other things. So let's go on looking at this screen here. What you'll see is in red letters, eligible for bonus depreciation, and a red circle around things. What that indicates is something called bonus depreciation, where you have components within a property which have a life of 20 years or less. What you're able to do is front end load a lot of those, the bonus depreciation for all those componentry within the first year or so, and that really accelerates that depreciation and helps you with your tax obligation.
So Julie's going to think these are milk buckets from Baton Rouge.
That's how you eat your cereal, probably.
Remind me to add 10% to her project.
What you'll see here are some of the different componentries. You can see in the bucket on the left, it indicates the 39, 27 and a half. That's what I alluded to earlier, where most property types have 39 years straight line depreciation, but your residential will have 27 and a half. And that's your real property or structural things. things that you're not going to be able to do a accelerated depreciation on. But then look at it, the next buckets with the 5 and 7 and 15 year. I won't read all those things, but you can kind of take a look at some of the componentry, which has a shorter life, and you can depreciate much faster.
Yeah, so if you look at all these parts and pieces of a building and assign a value to each of those, those 5 and 7 and 15-year buckets, you're able to depreciate those in the first year. So if you buy a new building, you can take the value of all these parts and pieces and have the deductions available to you in the first year. That's a substantial amount of cash flow. Somewhere between $30,000 and $80,000 per $1 million of building. So it's all about cash flow in real estate, right? This is how you can generate a substantial amount of cash flow by simply picking the right depreciation method, which is an accelerated cost segregation method versus just doing straight line depreciation. So again, here, the parts and pieces that are 5 and 7 year property that are eligible for this bonus depreciation. So Mark, what's that do to the curve? So in relationship to a straight line depreciation, which a lot of people are still using.
Yeah, take a look at that blue line that represents on there what your straight line depreciation is, and you can see with the red line that represents the accelerated depreciation. But then look at the blue line. That has been a real game changer with the 100% bonus depreciation, whereby you can depreciate so much up front.
Yeah, so the green line shows that you can take a lot of these deductions in the first year. And this was Congress's way of giving commercial building owners more cash flow in the first years to make deals work. This was passed a couple of years ago, simply to stimulate the economy. So, typically,
I'll just interject one thing there. Prior to that time, it was, you could do bonus depreciation on new construction, but not on acquisitions. In fact, I sat down with a owner of a property and their CPA and was going through it. And the CPA, with over 30 years of experience, was asking me, why are you showing bonus depreciation? That's not applicable. And I said, well, for an acquisition, I said, well, you're right a few years ago, but that's not the case right now. Our job is to stay on top of all the new rules and regulations in regards to this, and to be able to provide you with that guidance, because unfortunately there's sometimes a lot of CPAs and tax professionals that don't stay on top of all that, and they can't because they have so many things to do, especially the single practitioners.
Yep. So that bonus depreciation is going to apply to a new purchase, new construction, renovations that might be done. If you haven't taken advantage of it in the past, we can show you how to take advantage of that in the past, and we'll get into Section 179 in the CARES Act on improvement property. But the advantages is increased cash flow. You're actually it's actually acting as an interest-free loan from the government, in that as long as you own the building, you don't have to pay these deductions back. There is recapture when you sell the building, but it's a cash flow strategy, time value of money. You want the cash in your pocket now, so you can either go buy more real estate or have enough cash to pay the note, or to do renovations and remodels, to get a tenant in, if you're doing something other than multifamily. And it's just the advantages that the tax code brings. So it's substantially in your favor if you're selecting the right depreciation method, which is cost segregation, and you have a tax pro that can get that done for you. Just some numbers here on those that kind of results that you might see on the different types of buildings here, dental offices. But I understand the majority of the people here are multifamily investors. So apartment building, 1.2 million here, $63,000 of cash flow in the first year, if you can utilize that. Maybe some restrictions if you're a passive income participant in the property, but it will limit to you as to your revenue that you're getting, and you can drive that down to zero possibly, and carry whatever you can't use in the first year. You can carry that forward and utilize that in years to come. That doesn't run out. But more results on what the different type buildings yield. But you can see here in the 5-year cash flow, a lot of that will be eligible in the first year by selecting a cost segregation methodology. Julie, are there any questions, or should we stop here and
Yeah, let's have some questions. Let's open up some questions here. I do have my own questions.
Sure.
I'm looking at how you talked about recapture.
Mhm.
And on some of these deals where they're in it for 18 months to 36 months right now is really the hot way to go through these, but that's going to change, right?
Mhm.
But for now, these people are walking away with a bunch of money. How do they recapture? What is the effect? If you roll that right into the next in a 1031 exchange, or you go with the same sponsor into the next deal, tell me a little bit about that recapture. How is that going to affect your taxes?
That's
First of all, one of the first things that we do is in our preliminary questionnaire, we ask, are you planning on selling this property within 5 years? And the reason why we ask that question is because we want our clients to be cognizant of what the recapture ramifications are, and that it may not be advantageous if you're buying something and going to be doing a quick flip on it in a year or two. However, we have some clients that say, you know what, I know I'm going to be selling it in 2 or 3 years, and I know there's going to be a recapture tax associated with that, but I still know that with the amount of cash that I'm going to get, how I'm going to be able to invest that, and with the ROI that I'm going to get on that, that's going to far exceed whatever that recapture is. But that's really for someone who's pretty sophisticated and knows and understands the situation. But we typically recommend that clients do not do it if they're planning on selling it within 5 years.
Do not, let me just make sure I understand what you just said. Do not do a cost segregation if you're going to sell it within 5 years. Is that what you just said?
It may not be advantageous.
I'll say it a little bit different, Mark. I usually say 3 years, because what you're doing is you're paying Mark and I basically a closing cost to get an interest-free loan. Okay, so what are you going to do with the money? Are you going to plow that into the next property? What's your return on investment? So when you do have to pay the recapture on that, has the money grown? Has it increased? Have you made more than what you had to pay us to get the study done? The prices on cost segregation studies have come down substantially in the last 3 years or so, where it's going to be cost effective probably, but we want to make sure people stop, look at that, make sure they know what they're doing. So I usually say within about 3 years. Within about 5 years, it's usually worth it. Less than 3 years, I would ask, what are you going to do with the money? What's your return on investment for that money? So
Jim Biggs has a question. I'm anxious to hear it.
So as it regards recapture, this is an area that is probably at a much higher level, 300 level class, if you will. But for many of us that have been taking advantage of cost segregation for several years now, and we're starting to see some of those properties start to turn, this is a question that we really have not had for in-depth evaluation of. And so I guess this is more of a statement and recommendation, but we really would love to get a guest on that maybe you guys have worked with, that a CPA that could really dive deep into ways to mitigate the recapture, because I've heard a lot of people dancing around the periphery and the edges of this. And I do understand the time value of money, and if you can get that money, let's say you can get $100,000 and make 130 with it, and still have to pay back the 100 at the recapture, you're still 30,000 ahead of the game.
right.
No, but that's something I'd really love your guys' recommendation on. But I've got several questions, but I'll go back and ask just one, which is,
Jim, I wonder if I could just jump in there for 1 second. We actually have a PDF that explains recapture tax from Robert Taylor, one of our internal tax experts. And what I'll do is I'll make that PDF available to everybody.
You know what you could do?
To you, Julie, and to Jim,
Yeah,
and
why don't
anybody
you
else.
send it? Yeah, and I'll get it to everybody who signs up, and you'll get it in your Friday email. So I'll
Okay.
look for that. Yeah, thank you.
And I'll go one further, Robert and David, and say if we can encourage him to reach out, maybe schedule a future podcast with Julie to cover the subject.
Yeah.
So my question is, I know that for tax purposes, that your CPA will oftentimes reclassify certain expenses to make it more tax advantageous for you, the client. And so I'm interested in knowing how that affects the actual accounting from your property management standpoint and how it affects the NOI. Is it legal and ethical to reclassify things one way for taxes, but differently in your property management accounting systems? Because there can be a difference in how it affects NOI. And could you discuss that a little bit?
So books should meet tags. So those should be the same. What you're probably referring to is the tangible property regulations on what's a repair and what's an improvement. What do I have to capitalize and what can I call a repair and expense that? Is that what we're referring to, Jim?
I think that's one. Really, David, I think there's a lot of people that misunderstand how things can be reclassified for tax purposes, and how they account for them. As is it above the line or below the line? Because as passive investors, if you've got 50 passive investors on your deal, they want everything classified below the line so that it increases the NOI, not decreases the NOI, because they're going to get paid off of the NOI.
Mm-hmm. Right. Yes. So yeah, that may be a great session for another time to get that deep into things. So
Okay.
We'll swing around back to you on that, Jim.
Yeah.
Yeah. Although towards the end of the presentation, Jim, we'll get into some of those things as to small taxpayer safe harbor, where $10,000 or below per building, you can write any expenditures that you have on that building. You can write those off as a repair and expense that versus having to capitalize that. Another thing that we'll talk about is routine maintenance. So on a small taxpayer safe harbor, you want to track your expenses on a per building basis. So if you have multiple buildings in that apartment complex, you've got $10,000 of deductions per building that otherwise would be an improvement under the small taxpayer safe harbor.
Yep.
You've got routine maintenance. So there's a program where if you're going to do repairs and maintenance more than once in a 10-year period, if you have that outlined in your depreciation method for your taxes to say, hey, we refresh our cabinets every 10 years where we're swapping those out, or we paint every 10 years, or we paint every time that a tenant leaves. If you have that policy in place, you can call that a repair and write that off versus having to capitalize that as an improvement of those units. So those are two ways to use the tangible property regulations, as well as the de minimis safe harbor. So if you have an expenditure less than $2,500, if you're buying parts and pieces, replacing parts and pieces that are less than $2,500, you can automatically write those off. So those are all in the tangible property regulations.
Thank you very much. And Julie, if you run out of questions, I got a bunch more.
Yeah,
Okay, perfect.
Thank you for calling.
That's good.
Yeah, let's keep going.
Julie, you asked about 1031 exchange, and Jim's right. You've got to have an exit strategy. So, what do you do to minimize the recapture? Well, one of those is a 1031 exchange, where you can roll the rest of the depreciation that you have on that building into the next building, so that there is no recapture on that. A quirk in the regs is that says you cannot 1031 personal property, but there is a exemption for buildings that you've cost segregated in the past, that if 15% pass through de minimis exemption for buildings personal property. So if the personal property that you've accelerated depreciation on in the past is less than 15% of the new building's fair market value, there's no recapture. So the lesson is, buy a building that's bigger than the one that you have currently, so that you don't have any recapture on the items that you have accelerated depreciation in the past. Jim, are you familiar with this? Is this a strategy that you guys use? 1031 exchange?
Yeah, and I'm glad that you brought that up. We're not, most of these syndications are not doing 1031 exchanges, but you can, if you're reinvesting your money in another building, and if you're reinvesting at a higher amount than the recapture that you just had to pay in taxes, it's still a net gain for you. In other words, it's another way of kicking the can down the road. So I just had a $100,000 capital gain event. I reinvested in another building and maybe, even put another 25 grand in on top of that. And that might have initially only been a $75,000 investment. And so now I can get, for the sake of argument, let's say we're getting 100% bonus depreciation. So I had to pay back, let's say 80 grand in recapture, but now I've got 120 grand to offset that in new bonus depreciation.
Jim, thank you so much for saying that. I do lots of these. Very few of my participants are aware of that. And so thank you so much for bringing that out. And you're absolutely right. So as you said, if there's 80,000 in recapture, but you cost segregate the next building and you use the bonus depreciation, again, all those buckets that we showed you, there very well may be 120,000 of deductions there. So it offsets your repayment. Therefore, it's like going into a 1031 exchange without the restrictions of a 1031 exchange. That's very good. As well as if we can use a cost segregation study to reduce your taxable income. You mentioned if you have capital gains, what's your capital gains rate? Well, if your taxable income is above, I think $460,000, your capital gains rate is 20%. If it's between 78,000 and the 400 and something, your capital gains rate is 15%. If we can use a cost segregation study to take your income down, because we've used all of these deductions to drive that taxable income down below, I think it's 78,000 for joint filers, then your capital gains rate is 0. So if you've got a big capital gains number and you have buildings or about to buy buildings or have buildings in the past, you want to look at potentially reducing your income, taxable income below that 78,000, so that you can reduce your capital gains rate. So,
that is a huge, David, thank you so much. That is huge. And for those of us that are on a 1099 schedule, this is a huge impact, but I do want to talk to you about that. My CPA said only if you're on the GP, do I get to take advantage of the taxable income. Do you know anything about that on the cost segregation?
I'm not sure. Give me a little more
As
information.
opposed to passive. So if I'm a LP on a deal and I'm using my 1099 where I haven't paid the taxes on it yet, I'm trying to find tax strategies, and I go into a limited partnership,
Yep.
I do not get to take advantage of that cost segregation, as opposed to if I am an investor on a general partnership with the 1099 capital. Then I do a cost segregation, then I can utilize it. So I would highly recommend you talk to your CPA and figure out maybe being a limited partner is not the way to do it, and finding opportunities where you can get that tax deduction. And it really does depend on what kind of filer you are.
It does. Absolutely. So if this is passive income for you, you're restricted to being able to write off the revenue that you're receiving from that. So you can go down to zero, but you can't create a loss. If it's active income, if you are a real estate professional, according to the IRS, well, then you can take it below the loss because it's no longer passive income, it's active income, because this is part of your business. Or if you own the business and it's active income for you, you can have a loss, which you can carry forward. My caution to you is to say, okay, well, I'm just going to call myself a real estate professional. I'm going to check the real estate professional box and I'm going to get all these deductions. That's the number one thing that the IRS looks at. They have like a 300 to 1 win ratio in court for the people that they've taken to court that said, I'm a real estate professional, said, hey, I'm spending 750 hours a year managing my properties. And there's a couple other criteria. If you have a W-2 and you claim to be a real estate professional, that's a red flag in Washington, D.C. There's bells and whistles go off, and they're going to come talk to you. And they're going to want to say, show me your records. So if you're going to claim that, daily records as to what you did to manage that property. How many hours did you spend in it, so that you got a clear record that you've spent 750 hours managing those properties and you're eligible to be that. But that's the number one thing that they look at. So there was a court case where they looked at the guy's books and he had all of his records there, and they said, we noticed that all of your entries are in the same ink, probably with the same pen. It's like, we've never seen that before. Usually over the course of a year, someone uses a different pen to write down their, don't try and recreate the records and do it all the night before and think you're going to get away with it. They look at it very hard. So that's my best advice that I can give to you. If you're a real estate professional, yes, take it. There are lots of advantages. If you're not, look at it, Google it. It's pretty restrictive on what you have to do to be eligible.
All right, keep going because we're running out of time. So let's see what else great tips you have for us.
Okay, so here's a couple scenarios. So newly acquired business. So what are you going to do if you buy a new property? You're going to have a cost seg study done on it. You're going to choose an accelerated depreciation methodology. You're going to be able to take advantage of that 100% bonus depreciation, which is probably 10 to 25% tax deduction of the building. So that's going to be $30,000 to $80,000 per million. Does it create a net operating loss? No, if you're a passive investor. Yes, if you're an active investor and you can carry that forward. If you already own properties, you will do the cost segregation. If you haven't done it in the past, you can still catch up. It'll require a form called a 3115, and that's something that we can help your tax professional do. But if you've owned the building for a number of years and have not employed cost segregation, you're eligible to switch accounting methods. It's automatically approved, and you can then get the deductions that you deserve all in the present tax year. The tax code changed from last year. We won't go into that because that's expired. If you're doing renovations and remodels, tenant retrofits on non-residential, what you pull out of that building and throw away and put into the dumpster is worth money. You want to capture the value of that. You want to have a cost segregation specialist say, okay, here's what you're pulling out. Here's what you're taking out. We do a study of the building before you start the renovation, and we catalog everything that comes out so you can write that off, and then you can cost seg what goes back in, so you can kind of double dip. If it's a non-residential building, probably most of what you're putting in under qualified improvement property, you can write off in the first year. So what you take out is a deduction. What you put in is a deduction on non-residential. On residential, you're restricted. And I know there's a lot of people on the call, but you will be able to write off what qualifies as 5 and 7 year property that you put in. Again, have a tax professional, a cost segregation specialist come look at the building before you do major renovations so they can put a value on that. And Jim will tell you, what you throw in the dumpster, there's no recapture against that. So whatever deductions you took in the first 5 years, if you throw it away, there's no recapture. Just something to be aware of. Residential real estate, which a lot of the people on this call are, again, you're not eligible for the qualified improvement property, but still huge amounts of deductions available to you when you do those renovations. If you have a building that you're putting in LEDs in, the government's going to force us to make our buildings more energy efficient. So a lot of people have done this before. Again, that fixture that's there, when you rip it out, that has value. You need to have someone value that fixture and be able to write it off. The labor to remove it, a write-off. What you put back in is a write-off. So for a LED renovation, non-residential, typically 100% deductible cash flow. So you spend $1 million putting lights in, you're going to get $300,000, $400,000 of cash back because you're using the right depreciation methodology. Also, roof repairs, HVACs, these are things that can probably be written off as a repair. So if you're changing the shingles, if you're changing a roof membrane on a flat roof, more than likely that can be called a repair, and you can write that off as an expense. Cost segregation professional can help you through those decisions. HVAC, fire protection, security alarm, you can also write those off under Section 179. Again, Section 179 is not for residential rentals, but for non-residential rentals, office buildings and so forth. You can expense that as well. But again, you probably want to go through the decision-making process to say, is that a repair or is that an improvement? And we won't have time to get into that, a lot of that tonight, but that's what a tax professional is here to help you do that. So again, any renovation and remodels that you did on buildings in 2018, 2019, or 2020, non-residential again, but if you did renovations 2018, 2019, 2020, the regulations were such that you had to capitalize what was going in there other than the 5 and 7 year property. You can, under the CARES Act, that changed. So you can look back and go back and see what you spent on those interior renovations and write that off now. So that's something that's eligible to you. Again, non-residential, but just wanted to make that available to people. Mark, any thoughts here? I'm going to be respectful of everyone's time and allow them to ask questions. But
I know we're running out of time. I just want to go over, I know there was a question there in regards to the timeline is for preliminary analysis and things of that nature. What we do is we offer a no-cost preliminary analysis for any property nationwide. I put my information in the chat. What you can do is fill out a questionnaire that we have, which asks information about the property. And based on that information, we will come back within several days, based on the tens of thousands of studies that we've done, and provide you with a very conservative estimate of what your tax savings is going to be and what the cost of the study will be. Over 90% of the time when our clients follow through with the study, the savings they have is greater than the estimate because we underpromise and overdeliver on that cost. The cost of our study, 50% of it is due upfront upon engagement. The other 50% when the study is completed. The timeline is typically within 4 to 6 weeks. However, prior to our very busy tax season, that can get extended out to 8 weeks. And all of our studies do require a site visit. We want to make sure that hundreds of photographs are taken of every property, and we will maximize whatever your deductions are. We've never had a study overturned by the IRS. We will add no cost to defend the study in case you ever do get audited. So that's part of the cost of the study as well. Thank you.
All right, I do have a couple questions myself. Where is the legislation with 1031 and bonus depreciation? Where are we at with that?
That's a great question. There was some rumors that 1031 exchanges might be eliminated. I haven't heard anything to that, and that was during the campaigns. So I haven't heard anything on that, and also had a discussion today on bonus depreciation. We don't think that they're going to touch bonus depreciation right now. It's not mentioned in any of the tax journals, and it's not part of the discussion that they would change the bonus depreciation from 100% where it is right now to maybe 50% going forward. In coming years, it is declining. So, but we haven't heard anything on that. And there's still no definitive decision on 1031 exchange yet.
How much would I want to underwrite a cost segregation on a 100-unit building? What should I use? What number?
Mark, you want to answer that? So put me in cost.
Maybe you'd say, what's the cost of the study, Julianne?
Correct.
Somewhere between 5,000 and 8,000, would you say, David?
An extra 10% for Julianne, since she made those comments on those buckets.
Yeah. I love you. Okay, good. So
But again, that's part of the preliminary analysis we do. We show you what their savings are and also the cost of studies, so you can see the ROI and determine whether or not it's a good fit for you.
sure, I think that most of everybody should be doing this. So instead of waiting and trying to figure it out, if somebody could say, all right, if it's a property that's 100 and less, it's 5,000. If it's 100 and to 300, it's 10,000. Is there a breakdown how that works?
No.
Okay.
The reason why is because you might have a cost of, let's say, like a manufacturing facility or distribution, an industrial property, and the cost of that, and then you take a look at, let's say, like a medical facility or something which has a lot more componentry within it, or a hotel or office. It's going to take a lot more time to go through and do the analysis on that type of thing per dollar, and also per square foot. So you can't even take a look at it that way. So it really depends a lot on the property type, and each of the costs of the study is not based on a percentage of the savings. It's based on how much work is going to be required to do that specific property. So you can't really say that.
Okay, so people call me, they get a quote, they call insurance, they get a quote, they call you and get a quote at about the same time. Is that about the timing that we want to be calling Mark Gross?
I get called in at various times. Sometimes, like I'm working on some right now where they said, you know what, I bought a property in February this year and I want to have a cost segregation study done. That's fine. Others will say, you know what, I'm in the initial process and we want to have a rough idea as far as what the potential savings could be for us and our investors, and we'll do it that way as well. And so it really runs the gamut as far as when we're pulled in to do it. But typically it's done after the property is acquired. Or I've got one client right now, I did a portfolio of 9 of his properties recently, and he just contacted me, said he wants to buy 4 more. And so I said, well, start giving me the information so we can start giving you some estimates.
Fantastic. I want to open this up. I know Ruben had asked a question about who can be a real estate professional other than realtors. I think we could probably talk about people that are working W-2 jobs. It gets kind of difficult to say that they're real estate professionals. People can do it, but you're running the risk of having an audit. So it's people like who are working 1099s. I'm in the business, real estate, realtors, something like that. It makes it a little bit more easily to achieve because you're in the business. So,
Julie,
Krellin, you have your hands raised. You're on.
Yeah, thank you. David, Mark, thank you so much for the presentation. I do have a question since it's so competitive out there these days and we're often the bridesmaid. I'm wondering at what point you recommend that people go ahead and use that form to get an idea of what the cost is going to be. We want to be respectful of your time as well. And I'm curious if you have any guidance there.
Well, sometimes I think you get what you pay for. There are some, I don't want to talk about any names, but some of them will say, well, they don't require a site visit. Well, that's not going to hold up to any sort of an IRS audit. There's others that don't do engineering base, which is the gold standard of doing a cost segregation. So there's different levels and different quality. We've had some clients that have had cost segregation studies done by one of those other firms, and then we were able to go back in and squeeze more dollars out of it. Another thing is that all of our work is done here in the United States. There's another firm that'll outsource a lot of that with cheap foreign labor, and we just don't feel comfortable doing that. But nonetheless, what we'll do is we'll take a look at whatever the competitive bid is and try to see if we can match it. But again, from our perspective, you're really going to get what you pay for, and the return on investment is huge. And for instance, if you're going to pay another $1,000 or $2 for something which is going to give you more protection against the IRS audit than another one, that's money well spent. David, you got anything on that?
Yeah, Creelan, it's I've got 2 people on staff. That's their job every day, is to take buildings and run estimates for the clients to say, here's an 8-page study on what we think the cash flow will be, and here's the cost to get that done. So we'll do 50 or 60 a day. So don't hesitate to shoot me a number and say, hey, we're thinking about this building. What's the tax implications? I'd be happy to run that for you. No problems.
Great,
Awesome.
thank you. Will do.
Thank you. Great question. Well, I think we're going to close it up for tonight. And I want to just thank you so much for making us just a little bit smarter